Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and Ted Wainman. We are looking at Cohort today, which is a defense business. But before we do so, don't forget to like, share, subscribe, especially if you're one of our many viewers who makes requests to us on companies that you would like us to analyze. If you subscribe, then you will get an automatic notification when your video that you're interested in comes up. So let's dive straight in. So Cohort is a group company and in the defense industry. Now, when you look at their website and the homepage, you are presented with this statement. And let me read this out to you because it's quite interesting. We create solutions to keep people safe, acting with agility to find a better way, make smart decisions, and meet customers' needs. So where independent subsidiaries are free to grow and deepen relationships with the support of a steady hand. I thought that was quite funny. Bringing the expertise of the group to the ingenuity of our businesses to deliver purposeful innovation that protects us all. Now, that really doesn't tell you very much, apart from the fact that they seem to acquire companies and they have subsidiaries and they give them a steady hand. So here's what they actually do. Essentially, defense company, they have a group, I think is 5 companies. So Chess Tech, EID, ELAC, MAES, MCL, and SEA. And essentially, they are companies that are involved in defense around surveillance, advanced communications, sonar, things like that. And basically, their principle is we acquire SME companies that we feel have growth potential, and we kind of give them, financial oversight, management support, exchange of information and practices. So that is what they do. And we have to thank a couple of our viewers for recommending this company for us to analyze. So Kalsa G and Double Dig, thank you for your request. Here is your video. Before we go into the finances, just a note about the share price. Now, if you'd invested when they first floated in 2006, you would have made quite a bit of return, about 5 times that return. However, in the last year, and this is where timing is important, if you invested maybe 12 months ago, you would have made a slight loss. So we will go into the details for that very shortly. So Ted, take it away. Let's share what we found out about this company.
Well, good to see you, Moeed. Absolutely. And just a quick point, you mentioned timing is important. It's a mug's game if you think you can time the market. There are lots of people out there who think they can. I would suggest you're going to really struggle on that. So what we're going to be looking here is at the fundamentals. And very fortunately, they have just produced the preliminary results for the year ended 30th of April 2021. So these are the latest set of results. These are unaudited, so these are not the kind of the absolute final numbers. They haven't been signed off, so they are subject to change, but they do give you an idea. We've got the kind of the key headline results up at the top, but we are much more interested in the actual financial performance and in the sort of the detailed numbers. So we're going to scroll down and we're going to start off looking at the profit and loss account, which we find all the way down on page 22. Here we go. So what's the numbers telling us? Well, first of all, it's telling us that the business is profitable. So we can see the sales are increasing. That's a 9% year-on-year increase in sales. That's good, that increase in sales, although there's a caveat that suggests that if you are an acquisitive company and you are buying companies, then effectively you're buying sales. Okay, so that's different to a company that achieves, for example, 9% organic growth in sales, which is very, very good. Just buying an extra 9% of revenue doesn't necessarily reflect that the company is performing particularly well, it's just growing. And as you mentioned, they have 6 subsidiaries, for example. 6 now. They got a gross profit margin. It's about 37% this year, 39% last year. That sounds pretty reasonable to me. That means that for every pound that they sell, it's costing them about 60p in order to generate that sale, and they are keeping 40p. So that looks pretty reasonable to me. We've then got the administrative administrative expenses, sometimes referred to as SG&A. That's the sales general and administrative, the overheads, the costs of actually running the business, and they end up with a profit. Now you'll notice that the profit has dropped from this year to last year. So in spite of an increase in sales, you've got a drop. And what's interesting there is that a lot of that drop, I think, is due to what's going on here. So we've got lots of exceptional items. So you'll notice they've got the sort of the cost of acquisition of ELAC. They had a cost of relocation. So these guys, they're buying companies and then they're incurring costs in, for example, restructuring, SEA, restructuring, which basically means cost of redundancies is generally the reason, and then they sold off part of the business that they didn't want. So these exceptional items, they're highlighted as exceptional items because they're trying to say, look, you know what, they didn't happen last year, they're not going to happen next year, so they're kind of one-off. We also see there's a significant amount of amortization. That's another reason for the increase or the decrease in the operating profit, is the amortization of other intangibles. Okay, so this amortization is going to be goodwill, and effectively they're going to be saying, look, you know, we created goodwill on acquisition, but we're actually writing it down, and that's a pretty significant number in my book, that amortization. So that suggests that maybe they've been overpaying for their acquisitions. Maybe they've been overpaying, and we'll look at that and we'll find out a little bit more about that number because it's a pretty significant number a little bit later on. Down the bottom, let's just clear those annotations. So down the bottom, finance costs. So they're paying interest, and if they're paying interest, it means they've got debt parked on their balance sheet. But the interest is really not a problem when we compare it to the operating profit. So it's easily affordable, that debt. They're paying some tax because they are profitable and they are making a profit. Bottom line profit, 4% net margin, pretty tight. So £43 million turnover, £5 million net profit, reasonably low margin. But you know, I think that, you know, the story behind this company is that, you know, you can't amortize goodwill forever. If you take out all of these exceptional items, then you're going to start to see kind of underlying business is going to be kind of, you know, is actually, you know, much more profitable than that. Okay, so this is a, you know, a reasonably profitable business, and it is growing, but it is growing through acquisition, not organically. Important to notice that. Okay, let's look on at the balance sheet. So here we go to the balance sheet, and looking at the assets to begin with. So the first asset we see in the non-current assets, these are the things we need to run the business. Easily the biggest number is goodwill. Now you'll notice that goodwill is pretty high. We've also got some other intangible assets. We might want to know exactly what that is. So goodwill is pretty high, and it's still pretty high, yet there's been that amortization charge of 10 million pounds, which means that during the year they've added goodwill and they've reduced the goodwill. So they've amortized some of the goodwill, they've written down some investments, but then they've created additional goodwill by their acquisition of, I forget which subsidiary it was, ELAC or something. Otherwise, property, plant and equipment is looking pretty consistent, and they've got 79 million pounds worth of assets. Okay, but those assets are predominantly goodwill, and goodwill, it just arises on acquisition. You can't put it on eBay and sell it if you get into financial difficulty, for example. Further down, looking at the current assets look pretty reasonable to me. 112 million pounds. They've got some inventory. They've got some accounts receivable, and they've got about 32 million of cash sitting in the bank. So pretty much a reasonable amount of cash. And we might just want to quickly, while we're here, compare the current assets, that's 112, to the current liabilities. This is our kind of standard liquidity measure, and the current liabilities 58 million. And so that kind of, you know, that really says that they've got very, very good liquidity. You know, if we actually run that calculation, which is known as the current ratio, it says for every £1 they owe, and have to pay soon, they've got £1.92 either as cash or coming in as cash soon. Okay, so this is a kind of can they meet their financial obligations as they fall due, which in English is, can you pay your bills on time? The answer is yes. These guys have got a pretty strong balance sheet there, so looking pretty good. A little bit further down, we'll look at the non-current assets. So the non-current assets, biggest number in there is our bank borrowings. We kind of expected to see that. If you remember, they're paying whatever the number is. I forget exactly, £768 million in interest. So they'll be paying that on those bank borrowings. So the 769 interest represents, roughly about 2.6%. That's a kind of back of an envelope calculation. 768,000 on 30 million is about 2.6%. So debt is pretty low. Sorry, the cost of debt is pretty low. It's affordable. It's sitting on the balance sheet. It doesn't, there's no cause for concern, I think, there. So net assets, that's the assets less the liabilities, 85 million, basically saying they're about what's that, about 60% equity funded, 30% debt funded, so looking pretty comfortable. A little bit further down, here's the equity. The equity obviously is exactly the same as the net assets. This is why the balance sheet balances, if those two numbers weren't the same, there'd be a significant cause for concern. And what's interesting here is that the main numbers sitting in here are the share capital. This is the investment by the shareholders and the retained earnings. Okay, and the retained earnings is effectively the profits which have been reinvested back into the business. Now you'll see the retained earnings are only a little bit up on the previous year. They make a £5.5 million profit. The retained earnings have only gone up by about £1.5 million, which means that they must be paying out dividends, and we'll see if we can find that a little bit later on. You'll also notice just while we're here that they've got this account called own shares. So effectively what this is a negative liability, sometimes referred to as treasury stock. If you look in US accounts, this is a negative liability, which is an asset. And it's an asset because it's an investment, but it's an investment in their own company. So, for example, if this company was to buy another company, if it was to invest in shares in Chemring, for example, which is another defense company that we looked at, then it would appear in the non-current assets as an investment, but because they are investing in themselves, they can't show them as an asset, and therefore they show it as a negative liability effectively. Now that's quite an interesting number, and I'll show you why I think that's an interesting number a little bit later on. So let's go on to just checking this movement in equity. And here we see the movement in equity, and we're really interested in this column here. This is the retained earnings. And what we can see, in fact, let me just scroll down a little bit further, and we can look at, so we're interested in that column, but we're interested in this year. So here we show, this is the retained earnings at the beginning of the year. So that's the total amount of profit the company has made ever since it started trading, but not yet given back to the shareholders. Here's the profit for the year that comes straight out of the profit and loss account. Here are the dividends. We expected to see those dividends, and there they are. And what's also interesting here is we suddenly notice this. So this is own shares purchases and own shares sold. Now, this kind of, slightly sort of surprised me because it was like, well, they've been buying their own shares and they've been selling their own shares, which suggests to me that they're trading their own shares. And not only have they been buying and selling their own shares, but they've actually been making a loss on those. So you mentioned at the beginning that, if you'd been an early investor, you'd have made a lot of money, but recently they're coming off the boil. The question is, why are these guys buying their own shares? Are they trying to prop up the share price? Are they trying to kind of boost demand and sort of get the momentum back up again? Why would they be doing that? They're making, it's not a significant amount, it's £1 million loss, but that's still, that is still a loss on trading their own shares. So that whole kind of, what is actually going on here is a big flag, and I'm not sure what the management are up to in terms of, but I understand share buybacks, which is a way of returning money back to the shareholders. I'm not a massive fan of it because I think it's a little bit of subterfuge. I much prefer dividends, but I do get the concept of share buybacks, but I don't get the concept of share trading where you're just buying and selling your own shares. Maybe somebody has insight on that and would like to leave a comment in the comments box. Okay, so moving swiftly on, let's look at the cash flow statement, see what's going on. So what we see here is the cash flow statement. Now, the cash flow, they're generating cash in the business, 16 million, up from 12 million the previous year. If we want to see the reconciliation, which we should really go and have a look at, the reconciliation between the operating profit or the profit figure from the profit and loss account to that cash figure, we need to go and look at note 6. So let's whiz down quickly and have a look at note 6. So this is the reconciliation, and the reconciliation is really just saying here is the profit figure from the profit and loss account. That's a familiar figure with us. They make a whole lot of adjustments, and you'll notice the big adjustment here is amortization, because if you amortize an asset, which is basically you amortize intangibles, you depreciate tangibles, it's a non-cash expense. So it will reduce your profits, but it doesn't reduce your cash. So when you want to look at the cash in the business, you need to add it back. And so what we see is that they're generating lots and lots of cash, 20 million. There's a movement on their working capital, which is going on here. A little bit of tax being paid, and the interest as well. And then the total comes down to 16 million. So 16 million, very, very strong cash flow, which is good because we like companies that generate lots of cash, and these guys certainly are generating lots of cash. So we go back to our cash flow. There's our 16 million. What are they doing with that 16 million? Well, they are investing. And as we mentioned, they are acquiring. So there's the purchase of property, plant and equipment. They're doing that every year. And here is the acquisition of ELAC SONAR, net of cash acquired. So they spent 1.3 million growing the business up from 5 to 6 in their kind of their suite, their portfolio of companies, and what they're trying to do is to give them a free rein, but also create the synergies. That's where they can maybe it's a kind of customer service, maybe it's customer relationship. What they're looking at is bringing complementary organizations into their portfolio of companies. And then the final section is financing. So here we see the dividends being paid. So they're consistent dividend payers. So if you're an investor, you're getting dividends, which is good. And then you also notice the next line, let's just do that in a different color so we highlight it, is this own shares bought and own shares sold. And this again looks like not only were they doing it this year, they're doing it last year as well. They're trading their own shares, they're buying their own shares, and they're selling their own shares. Now, we mentioned earlier, only a mug tries to time the market. They will be restricted on when they can buy their own shares. Obviously, they can't, say we're about to make a big announcement of a loss. We'll sell our shares today and then announce the loss tomorrow. That would be illegal because that's insider trading. So it just looks to me, especially as we saw they were booking a loss on trading their own shares. It's kind of like, why would they be doing that? And as I said, that doesn't really make a lot of sense to me. They also notice here the borrowings. So we've got some drawdown of borrowings, a repayment of borrowings, and repayment of leases. So here we're looking at, so we would tend to take these two numbers together. They're borrowing money and they are repaying that money. So that's understandable. Sometimes we draw down today, we repay it tomorrow. It's part of our working capital. That's absolutely fine. But what we see is on a net basis from the financing, they're actually generating an additional 12 million from their financing activities, which is primarily driven by the drawdown of borrowings. That's really where that number is coming from. Sorry, no, my mistake. Scrap that. So what we actually is looking at is, sorry, the net cash used in the financing activities is negative. So it's a slight reduction in cash as opposed of 1.5 million, which is effectively drawdown of borrowings to repay and also drawdown of borrowings to fund a purchase, is effectively what's going on there. And therefore, if we take our 16 less 2.5, less 1.5, we end up with additional cash of about 12 million. They started the year with 20 million. Okay, that's sitting up here. They add in another 12 million and they finish the year with 32 million. So they are generating cash. They are using some of that cash to fund their purchases. They're using some of that cash to invest in the business. They're paying their dividends. Sorry, I should have actually pointed that up here at the acquisition, not at the dividend. They're paying out dividends. It's looking pretty good. So, you know, as far as I'm concerned, I'm kind of like, I'm thinking, you know, there's no real warning signs on this company apart from this trading of shares, which just looks, you know, slightly crazy. But you know, hey, who am I to comment on that? So you mentioned the share price, and here is the share price. So if you'd got in early, you'd have bagged a bargain, and we can see kind of a meteoric rise all the way up to the beginning of 2020, and then it has come off the boil somewhat. So it's dropping a little bit now. You may think, is that a buying opportunity? Is that a sort of a great opportunity to get in early? You know, we look at the market valuation. We can see, let me just put that in a different color. So the market valuation, 217 million, which is 40 times earnings. So if you buy this company and it doesn't grow at all, then you are gonna, you know, spend 40 years waiting to get your money back. So it's expensive. The yield is a 2.5%. This is the dividend yield down here. This is if you invest just for the income, then you're getting an income of 2.1%. We live in a low yield environment. You might want to think about, you know, the sector that they're in, the defense sector. Is that solid? You know, certainly defense isn't going to go away anytime soon, but it's relatively competitive. So yeah, 40 times earnings, 2.5% yield, 2.1% dividend yield. There's inherent goodwill. So the balance sheet is 85 million. So inherent goodwill of about 132 million in there. You're paying 2 times sales, if that's a metric that you want to use. So, you know, are they a buy or are they a sell? You know, they look expensive to me, but I don't see any major problems. It looks a pretty solid, you know, we've looked at some companies which are basket cases and look like they're about to run out of cash anytime soon. So, you know, this looks to me like a well run company. It looks like it's part of any would form part of any diversified portfolio, but it's expensive. Okay, there's a lot of good news, but the good news is priced in.
Yeah, and so certainly have a look at, you know, what I'd encourage all our viewers is, you know, we've only given you one part of the investment thesis, which is the fundamental financial analysis. However, when you look at the numbers look reasonably healthy, and yet the share price has been going down over the last 12 months compared to the industry average, where actually it's been going up. So there's something in there that hints at something in there that you might want to do more research on, whatever that might be. It could be anything. So we encourage our viewers to do that. Remember, this is just the fundamental financial analysis that we're looking at in this video right now. So Ted, that was a great summary of the findings that we found. You know, as I said, like, share, subscribe. But if you are a viewer, as with so many of ours that are doing this right now, do leave a note in the comment section of a company that you would like us to do analysis for you on. So whether that's a company that you're thinking about investing in, maybe it's a company you're thinking about doing business with, or even if it's a company that you're interested in. Now, there is one video that we recommend you look at after this video, which Ted mentioned, and that's a company called Chemring, which is in the defense space. So you'll start to see some more information, some form of comparison, or just have a look at what's going on with another company in that industry. So have a look at Chemring, which is a company that we analyzed earlier. And until the next video, thank you, everyone. Thank you, Ted, and we'll see you shortly.
Good to speak to you, Moeed. See you later.